Gilbert, CEO of WealthWise Financial. With me today is John Milligan, our Director of Investment Strategy. And we are here today to give you our mid-year outlook called our WealthWise Viewpoint. So John, let's start by looking at what we talked about year end.
Yeah, absolutely.
And then I'm gonna kind of run through our agenda for today's video, and then we'll go back and do it. So first we're gonna start with what we said end of year. Then we're gonna look at the large cap markets, then look at small caps, look at the fixed income markets, look at international, touch a little bit on real estate, and then also talk about our expectations for the rest of the year. So with that, let's look back at what we said at the end of last year.
Yeah, so if you look back to our presentation, which is available for clients, you can look at it. On the last slide, which we titled Takeaways, we said that we were going to retain some exposure to large cap value, but that we're also going to retain a strong exposure to large companies that could benefit from what we at the time we referred to as generative AI, but you'll hear us refer to it as other things such as AI or accelerated compute or other items. But we kept an overweight there, but we continue to just look for new opportunities in the large cap space, which we'll discuss a little bit further. The next point was that we are overweight on smaller companies. A lot of that has to do with the fact that large companies are in that top decile of valuations, very expensive. Small companies are very cheap right now. And so we're looking for some great opportunities there. We were looking for them at the end of last year. We continue to do so. We'll talk about how that's panned out. And then lastly, we talked about this idea that fixed income will have its moment. It's been a rough 3 years for bonds with the Fed rate hike cycle, but with that coming to an end, the moment will come. So we'll talk about that a little bit more.
Fantastic. So let's talk about large caps because one, it's the largest part of the market.
Yes.
And as far as portfolio construction, also the largest part of our allocations.
Yeah.
So let's talk about kind of what's happened so far year to date, and then what we're looking at now.
Yeah, and so this is another year of dispersion. It's a good way to describe it, and we'll describe it this way. Within the large cap space, the S&P 500 has been up around 16% year to date. Dow Jones Industrial Average about mid-single digits. So, why is there such a big difference there? And the big difference has a lot to do with the fact of what the S&P 500 has, which has done well to date, compared to everything else. And a lot of that is semiconductors. The semiconductor space continues to do really well.
And we've had exposure to the semiconductors in a couple different ways. Why don't you explain that?
Yeah, we made a large allocation of the semiconductors broadly early in the year. We'll talk about why. We've increased that exposure. We did that about 4 to 5 months in. We increased exposure, added some direct exposure to NVIDIA and some more aggressive portfolios. But semiconductors, there's about 250 industries that are represented in the S&P 500, and semiconductors on a performance basis has been near the top. And a lot of that has to do with the idea of AI and the AI build out. And we're going to talk about this a little bit more, but this whole idea of AI and how to invest in it, we're seeing it in 3 phases. The first phase is the build out phase, which is what we've been in. So all the companies that provide the tools to build the infrastructure that's going to underpin AI and help it be developed, that's where a lot of the money's been flowing. But money's got to be made off AI. You can't just
monetize it.
Yeah, you can't just create it. And so we're starting to see market attention start to turn towards those companies that are going to be able to monetize it. And we'll talk about that a little bit further. And then lastly, there's going to be the broadening out. And we'll talk about how there's the advent of new technologies. We'll talk about the steam engine, electricity. We'll talk about the internet in the 90s, how many years it took for that to have its productivity impact on the U.S. economy.
So John, let's talk about some specific equity purchases that we've made in the past and present in this area of semiconductor and AI.
Yeah, absolutely. So in the past, we've been invested in a company called Advanced Micro Devices, which is actually the CEO of Advanced Micro Devices is the cousin of the CEO of NVIDIA. And we purchased that for around $45 a share several years back. Sold it around 160, still trading around 160. And we are now mostly invested broadly in semiconductors because, to be broadly invested in semiconductors, It means that you're investing in the companies that are helping build out the connectivity systems that are going to go to the data centers, the companies that are going to help build out the lithography machines that are going to allow them to actually make the semiconductors, and companies that are making memory chips, lots of other items. So the reason why we like the broad-based build out is because in the accelerated compute space, because you have an existing infrastructure of compute. And the existing infrastructure is largely data centers that are built for storage and for CPU processing. And the accelerated compute side is more on the GPU processing. And when we break it down to numbers, last year we saw a little less than $100 billion invested in the accelerated compute space. So this is the whole AI compute. This year we're projecting about $150 billion to be invested in accelerated compute. In 2028, we're expecting that number to be over $630 billion. So still a strong ramp up. And even though we are investing in NVIDIA directly, we don't necessarily see NVIDIA as the one and only beneficiary to this build out over the next several years. And so
right, the next phase is really how all these other companies are able to monetize AI, implement it, and that has broad implications. Some other investments that we've made, even with Tesla, for example.
Absolutely. So Tesla's a really interesting story because we started investing in Tesla right before they were put on the S&P 500. We saw some pretty quick gains in that position, and we started to take the position down. And we took the position down by about half once we got into the 2022 when the market went that pretty serious route. And at the very end of 2022, where it looked like a lot of the selling had moved from being worried about rate hikes to just people taking losses so they could write off their taxes, we bought some more Tesla at the end of 2022. And then in 2023, we saw it more than double, so then we sold off about half of it again. We entered this year with about half the Tesla position that we'd had from the previous year in our moderate portfolios. And this year has been, kind of a rougher year for Tesla because two things happened. One we first saw. The one that we first saw was the slowdown in the car market. We kind of foresaw that happening, and so one of the reasons why we drew down our position. But the one we didn't foresee happening was the Delaware judge striking Elon Musk pay package. Well, at one point, Tesla had gone as low as negative 40%. We did buy some more shares below 200, and we'll talk about what we like on the long term there. But Tesla since has seen their orders beat expectations. That actually happened last week. And in June, the shareholders reinstated Elon's pay package. And so the result of all this is the stock has gone from all the way down to negative 40%. Now they're up to where they started the year at. Got some pretty good momentum. A famous technology analyst, Dan Ives, recently said they're the most underappreciated AI play, and we tend to agree because when we talk about companies that need to monetize AI, Tesla is a good potential example. They have a massive fleet of cars that are all learning how to drive on a neural network, not just being programmed how to drive, they're actually doing the learning themselves. And by the AI engine studying the video, this is a company that's involved in robotics. Their energy business has doubled over the past year. They are essentially the ubiquitous standard for electric car charging now with their supercharger network. There's talk about other companies taking on their AI systems to implement into their cars. There's just a lot of opportunity there, which is one of the reasons why we're going to continue to retain a position in Tesla.
Yeah, and I think with both the examples that we've been talking about, both with AMD and with Tesla, the important thing to note is looking at that opportunity of when to buy, when to trim, when to sell.
Yes.
And so it's not just the company, but it has to do with how you buy that company. And so that is something that we spend a lot of time and research on to make sure that we're being very thoughtful with the price that we're paying on a certain company, and then how we're either increasing that position, decreasing, or fully selling it.
Yeah, absolutely. And so we've been kind of discussing this AI for a moment, and there's things that are tangential to AI. We're overweight in utilities right now, and one of the reasons why we like utilities, but not the only reason, is that there's going to be a lot more power demands in coming years, and so utilities could benefit from this, but also we just like the price that we paid for utilities when we made most of our purchase in late last year. It came in at a really attractive price multiple. But other areas of the market, just to get outside of the AI and the large cap space we like, one of them has been Walmart's. So we've been investing in Walmart for a few years now, and one of the primary reasons, of a multitude, but one of the primary reasons was that Walmart has a massive distribution network, a lot of existing capital, lots of existing stores, and at the time it was trading at a reasonable price. And Walmart is a company that can take this existing capital and then add a digitization layer on top of it, like what Amazon does, and essentially compete with Amazon without much more necessary capital. And so this has been the year where we've really started to see Walmart's strategies play out. Digital sales have been growing very strong for Walmart, and that's led to the stock being up about 33% year to date.
Right. So another one that's been a longer term hold. We saw that opportunity of digitization, and took a little bit of time for Walmart to actually implement that strategy well. Now we're seeing results from it. So sometimes there's patience with waiting for a company to actually have the results that we're looking for.
And that's one of the harder things about investing, is that you can have an idea, but it sometimes can take a little bit of time for that idea to take hold. Another position in an area that we like, that we recently increased our exposure to, is industrials. And a particular name aside industrials is a company called Honeywell. And we like industrials broadly. We think that there's opportunity in aerospace with aging fleets. We think there's opportunity in defense with everything that's happening geopolitically. We think there's opportunity in infrastructure spending. Both in developed economies and emerging economies. The AI data center build out, that's going to benefit industrials as well, because a lot of those companies are going to support that build out. So there's a lot of area industrials that we like, and Honeywell is a multi-sector conglomerate within industrials, and so they do a lot of work in aerospace and utilities and buildings. Your thermostat might even be a Honeywell. So they do so much different stuff. And late last year, they kind of reformed their company to focus on three key trends that we like. One is automation, one is the future of aviation, and the third is energy transition, essentially, helping us rework this entire grid. And Honeywell is one of those companies that we're waiting to see if their strategy really starts to bear fruit. We're paying a lot of attention to their earnings calls and what the management is saying. But in general, we've also been increasing exposure to industrials broadly.
Right. Anything else in the large cap space before we move on?
No, absolutely. I mean, that's there's a few more areas that we like, and we are just looking for a lot more broad-based opportunities. But yeah.
Okay, so then let's move on from large caps to small caps. And so we said at the end of last year that we saw an opportunity in small caps.
Yes.
And we have been very specific on what we were looking for, and that's profitable small cap companies. So talk a little bit more about that and compare that to the broader market.
Absolutely. So, in the small cap space is an interesting one, because you really, you can go out there and you can find great names, great companies yourself, but they're small companies, they get less attention, and sometimes they just get a little less attention from the markets, or sometimes a little bit more idiosyncratic things can happen to the companies that would be difficult to predict. They're less diversified in the revenues, and so a really great way to invest in small caps is to invest in great small cap managers. And so one of the things that we did was we set about a campaign to really interview a lot of managers. We got on Zoom calls, we met with the heads, we had lots of conversations, and we have two primary small cap investments. One is on the value side, the other is on the growth side. And one of the criteria that we really wanted to make sure with these managers was that they were investing in largely profitable companies. So the Russell 2000, which is the index for small caps, if you look at it and break it down, only about half of the companies in that index are actually profitable. And so when we made our investments, we are actually, at the end of last year, we were more than 80% invested in profitable small companies. And we think that that's really played out here today, because small caps have had a rough year, with the Fed, possibly going to cut rates, not going to cut rates. It's caused the price of that Russell 2000 index to roller coaster around. It went as low as -5%. Now it's about +1% on the year. But our small cap value position is outperforming its small cap value benchmark by about 5% year to date. And our small cap growth position is outperforming its small cap growth benchmark by 15% year to date. And it's only one of 10 institutional share class small cap growth funds that's outperforming the S&P 500 year to date. So out of more than 300 small cap institutional growth funds that we could review, 1 of 10 that's outperforming the S&P 500.
And so that just shows how it's so important to pick the right managers. Just like what we were talking about in the large cap space is somewhat where we focus on picking some individual securities as well as having broader base in the large cap, and in the small cap focus on picking the right manager and doing all the due diligence, because that is so critical in finding those managers who are going to really create that excess performance against the benchmark that we're looking for. So like you were saying, the rate environment significantly impacts small cap.
Yes.
And so the theory behind having more of an overweight there is the expectation of rate cuts, which will eventually start, but we're on this wait. So let's just talk a little bit about the Fed, because so much is dependent upon the Federal Reserve starting those rate cuts, and one of them being small caps. It's much easier for the smaller companies to access financing as rates come down than having higher interest rates. And then of course we also know that fixed income is significantly impacted by rates as well. So let's just address the Federal Reserve. And so what we came into this year with the expectation from the Fed that there might be quite a few cuts, and then now that's been tempered down to 1 or 2 cuts before the end of the year. But our thought is that we know that this trend is our friend, even though we haven't started the rate cuts yet, that the rate cuts are coming. So whether it's 1 or 2 before the end of the year, and then most likely, full percentage point next year, so maybe 425 basis point cuts. So that whole trend, talk a little bit about how that will help.
Sure, yeah. So as we entered this year, market expectations. And so you can go on, like the CME, FedWatch, these different websites, and they will take different, financial products, and they'll be able to extract what the market expects from Fed cuts year to date. So when we entered in the year, there was an expectation for 6 Fed rate cuts. We thought that was a little bit aggressive, but overall we were expecting, some, Fed rate cuts, 3, maybe 4. Now the market expectations, they went to as low as just expecting 1, so there was a big slide down. Now after some recent comments from Jerome Powell about some, with some more data that looks pretty good, now the market is about 20% 1 cut, 40% 2 cuts, 20% 3 cuts. So you can say it's kind of like, right around 2 cuts is what the market expects. But regardless, the Fed rate cuts will be a boon to small caps for 2 reasons. One is you touched on the debt. So right now in the U.S. Especially, if you look at large companies, Microsoft, Apple, etc., they are sitting on piles of cash. They don't need necessarily to go out and take on more debts. But smaller companies are on average about 3 times more reliant on upcoming debt issuance than the large companies are. And so that's been one factor that's kind of impacted small caps a little bit. The other factor is that small companies, like we mentioned, half of them are profitable, half of them are not profitable. You typically price a company based off of the profits they generate. And when a small company either has low profits or they're expected to make a profit way down the road, the higher the interest rates, the more those profits way down the road are discounted. And so the general discount rate that's applied to investments can impact small caps much more severely. So we have gone a little bit overweight on small caps, and a lot of that is just because in this environment, we see them as, kind of bargain shopping. So we've been bargain shopping small caps a little bit.
So let's just segue to fixed income.
Sure.
And so at the end of last year, we talked about keeping credit quality high and extending duration a little bit with that expectation of rate cuts. So let's talk about what we've been doing.
Yeah, so in the bond space, this is definitely a space where, there is an opportunity in bonds because typically, and I will describe it this way, when you look at a bond, you can just look at a handful of factors. You can look at a factor of credit quality. So is it a more risky bond or is it a more high quality bond? And then you can look at a factor of duration. So how long is that bond out for? Is it a bond that matures in 1 year? Because if it is, interest rate fluctuations aren't going to impact it that much because it's about to mature. But if it's a bond that matures in 10, 15, 20 years, then interest rates actually impact the price of the bond much more severely. And so you can measure this with something known as effective duration. And effective duration implies if the interest rates were to go up 1%, what would be the percentage change in your bond to the downside and vice versa, because they're inversely related. And so with our bond portfolios this year, we've been running about 5 to 25% more duration than our benchmark. And with that comes a little more sensitivity to interest rates. And so with interest rate expectations decreasing year to date, cut expectations decreasing year to date, that's actually had a negative impact on our bond allocation. And we've been able to offset this effectively by going overweight preferred securities. So preferred securities don't really have as much interest rate sensitivity. And so without the preferred securities, our bond allocation would be underperforming by about 1%, but with the preferred securities allocation that we've made, we're actually outperforming on the bond side by about 1%.
And just to clarify, the preferred securities are part of our bond allocation.
Correct.
So altogether, we are outperforming on our fixed income by including those preferred.
Yeah, great clarification. So preferred securities are what's known in the industry as a hybrid. You can think of them as stock or bonds. They behave like a little bit like both. And so we actually have put them into our preferred stock allocation. Also, a little bit of an overweight to mortgage-backed securities has benefited us as well. But whenever the rate cuts do seem a bit more real, that's when we think that you're going to really start to see that price appreciation on bonds. And we can show a chart here. From peak Fed rates as measured by CD rates over the next 12 months, bonds with duration tend to outperform CDs or money markets by about double. And so you can typically see within a year to 2 years a double-digit return on bonds, whereas your return on money markets and CDs start to go through a continuous decline as you get to a rate cut cycle.
Yeah, and so what I've been talking to clients about recently is saying if we could go back a couple of years when you could buy a home and have a 3% mortgage rate, wouldn't you lock that in? Mm-hmm. And of course, everybody says, yes, I wish I could do that because rates are now 7%. Mm-hmm. And right now we have that opportunity in the bond markets to actually lock in to higher yields on our bonds to pay out over the next 5 or 6 years with the expectation of nice yields for longer. And so for people who've had excess money in money markets, and there's over $6.5 trillion right now in money markets, now is the time to be looking and moving. That's what we're talking to clients about. Get in those bond funds that are yielding nice yields, and you'll be able to lock into those. And not only is there that yield, but there is also some capital appreciation that we're expecting as the rates come down, and that is what you can see on that chart. And unfortunately, a lot of people are going to miss this. A lot of people are going to be sitting on the sidelines, and when it happens, it's too late. And that movement will probably happen before the Federal Reserve announces or even starts to lower rates. So this is the time to be doing that. We are well positioned in our fixed income portfolios.
Yeah, and just to break down the pricing, so you can buy a bond portfolio today. A really high quality bond portfolio might give you a distribution yield. So that's like what it's paying out in cash. It may be anywhere from 4 to like the low 5s. And so you might look at money market and think, okay, well I can get 5%. Why would I buy a bond fund at 4% or 4.2%, et cetera? But first point, as we noted, money markets can go down. So it's not like you're necessarily guaranteed to get 5% over the next year. It's just kind of what it's paying right now, but it can fluctuate. But if we think about it, like Loreen had noted, the price movement typically happens really quickly. So you could get 4% annually on the distribution. And then once they start cutting the rates, the prices could jump by 6, 7, 8%. And so if the prices jump and you miss that, when you buy in, your distribution yield is actually going to be lower because you have to buy at a higher price now. So not only did you miss the price increase, but now you're going to be buying bonds at a lower distribution yield. So, you have kind of both of those factors playing against you on the bond side.
Okay, let's shift to international markets. And we have been much more domestically focused than international, because we still haven't seen clear skies internationally that we would like to see, and we still see problems all over the world, definitely. But let's talk about where we do see some opportunities.
Yeah, absolutely. So let's start with emerging markets. Emerging markets, another one of these areas where great to have a good manager. We are blessed in the United States that we have such a great financial reporting system, and the SEC and all these other groups down top of companies to report well. Not necessarily always the case in emerging markets, and so it's really great to find a great manager with a great track record. And this is part of our process of interviewing these managers and really getting an idea of how they work on things. And so in the emerging market space, it's been a mixed bag. Brazilian equities, as measured by the MSCI, are down about 20% year to date. China continues to struggle. China, is just slightly negative year to date. But then you've got spots like India, which has been seeing a lot of inflows from companies leaving China and doing production in India. India is up about 16% year to date. Argentina, with the election of Javier Milei, who has been effectively combating inflation there, also up about 16%. So a mixed bag. And when we look in the emerging market space, we are about in line with our index in terms of weighting. The index is up about 9% year to date. Our manager is up about 11% year to date. So really, been doing an effective investment selection in that space.
And in developed markets?
Yeah, developed markets, if you look at the index for developed markets as measured by the IFA, which stands for Europe, Australasia, and Far East, mostly Japan, that index is up about 7.5% year to date. Japan's been great year to date. We have some directed investments in Japan. Japan has a lot going on with kind of a general economic restructuring in Japan. Their deflationary concerns aren't as much of an issue anymore. Deflation has been a plague on Japan because deflation prevents people from spending money. Tourism has been booming there because the yen has been weak. They're moving from more of a shareholder-friendly model instead of a stakeholder-friendly model. So we've got some direct investments in Japan, but the rest of Europe there's some stuff going on there. Old industries, stoic industries. Germany's got struggles. France is going through a whole geopolitical thing, and unemployment continues to plague areas like Spain and Italy. It's just we like Europe for potential value play, and that's actually, if you look at our European investments, they are more value oriented, not as much growth oriented. But we definitely could see opportunities popping up in Europe, especially with the ECB, the European Central Bank, getting more aggressive with rate cuts. We could see opportunities popping up here, which we may take advantage of, and might actually take us a little bit overweight in that area.
Yeah, so with Japan, that is actually a potential travel recommendation because of the currency situation against the dollar. So a lot of people are talking about traveling over to Japan right now.
Yeah.
Okay, John, so now let's talk about real estate just briefly, and then we'll talk about our expectations for the second half of the year.
Yeah, absolutely. So real estate, everyone's been hearing the stories. Vacancy rates, particularly in office, they do remain elevated. You can read lots of stories about office space in San Francisco and New York going for incredibly low prices. But other areas of real estate, industrials, data centers, residential, multifamily, vacancy rates have stabilized and have been running pretty stable for the past 6 months. We don't see real estate as much of a risk as maybe it was even a year ago, but we are underweight real estate, and we'll continue to reevaluate the position through the rest of the year.
Okay, so let's move into second half of the year. We've seen excellent run up in the first half of the year. Second half of the year, a lot of people are looking at that the U.S. has a big election coming up, and then we have a lot of elections around the globe as well. And let's talk about just starting out with the S&P for the rest of the year, what we see.
Yeah, so the S&P 500 continues this year to be a carriage drawn by a handful of large horses, and we think that they will continue to drive it forward some more. And but our expectations are that the second half of the year isn't going to be as big as the first half of the year, which would take it above 30%. That's not our expectation. We do think some of these large cap growth names are going to bring it forward a little more, and that there's going to be some other areas of opportunity. Probably in the second half of the year, going to be looking for more buying opportunities, kind of restructuring the portfolio a little bit. Elections are interesting because when you think about investing, you've got two things that could affect investment. That's the risk, that is your known knowns, and you have uncertainty. And uncertainty is more around the unknowns. And elections generally present this kind of idea of uncertainty that can affect stocks. But once an election goes through, there's usually a period of calm. And so we see all this second half of the year as a good time of year to really think about where the opportunity is going to be going forward.
Yeah, so talking about those opportunities, we see the marketing broadening out from just being that handful of large companies, and because we see this huge disparity between those large growth companies and the rest of the market, we see the idea of investing in these other areas with the broadening out and having that expectation in addition to that large cap continuing momentum. And we really like fixed income because of all the opportunities that we mentioned earlier as well.
Yeah, I mean, if stocks even run sideways for the rest of the year, but the Fed does start cutting rates and we get a nice even double-digit pop in fixed income and small caps, that'll be enough to really kind of take things forward a little bit. So that's how we're kind of positioned for opportunities in the second half of the year.
Right. So with that is our mid-year outlook for WealthWise Financial and our WealthWise Viewpoint. Thank you for joining.
Thank you.